Mate, credit score is huge. You can pretty much be absolutely stuffed before you even get started. So it's really, really important that we review this. Your credit score is basically a metric of your credit profile, and there's contributing factors of the type of debts that you apply for. So applying for home loans can increase your credit score. Applying for credit cards decreases it. Late payments decrease it. And things like defaults, you know, where you missed it or you had an Optus bill from like 6 years ago and you forgot about it and thought they'd never get me, all that shit will catch up to you. So we've really got to review it before we even get started. So it's really, really important. But there's also services out there that if you've got a default from, you know, someone hacked your details or there's an issue or an actual genuine reason, you know, we can get this fixed up on your file. It might take a little bit of time, cost a bit of money, but if that takes your credit score from, you know, a 400 because of that default, you know, back up to a 900, then you're back in the game with the mainstream lenders and they're not going to see you as a risk, better interest rate, etc. If we're going to stick with that 400, we've got to go with lenders that need a 20% deposit, a lot more terms, a lot more fees because the risk is higher. So it's really, really important that we review that credit file and get it sorted before you get started. Now, equity, if you got it, we need to use it. If you've got lazy equity sitting in a property and you're not being active with it, you're missing opportunities. So for us, we deal with a lot of investors who always want to get their equity out, and I'm the same as well. Whenever there's an opportunity for me to get equity, I want to obviously get that and I'll put it in an offset account. So it's sitting there basically like a big line of credit. For when I'm ready to use it, I've got the money ready to go on that side of things. So if you don't have your equity out, you're missing potential opportunities. Yeah, you can certainly pay your mortgage off early. You know, even though it's a 30-year loan term, we don't have to do that. It just depends on your risk appetite and what you're looking for. I know there's other brokers out there that say, yeah, let's pay your mortgage off in 7 to 10 years. But rather than paying that one property off that doubles, you know, and goes from 500,000 to $1 million, you know, wouldn't you rather get that equity or put those additional funds in to buy more properties? So if you had, you know, 10 properties worth 500,000 and they all doubled instead of one, you know, yeah, I paid my mortgage off in 10 years. It's only gone up, you know, 500,000 in total. But if I had done that with 10 properties, hey, I've got 10 properties now that have doubled, and here's an extra couple of million in equity. So that same money that you put into your home, you've just missed the opportunity in the market elsewhere. So your loan to value ratio is essentially how much your property is worth to how much that you owe. And banks will use their risk ratings and also lenders' policies around certain metrics. So if you've got a property worth $1 million and there's a loan of 700,000, your loan to value ratio is 70%. So it's a sliding metric of how much your property is worth. Initially, when you're getting started, you might be doing a 10 or a 20% deposit. So if you're doing a 10% deposit, your loan to value ratio would be 90%. If you're doing a 30% deposit, your loan to value ratio is 70%. But as your property is increasing value over time, but your debt stays the same, that loan to value ratio goes down and presents you an opportunity to get equity out or renegotiate your rate because your risk rating's gone down.